Ladies and gentlemen, it has come that time in which we will have our first trader strategy session of 2023. For anybody who might be new, this is where we bring our team together and discuss some of the themes that we're going to be seeing over the course of the next several weeks. In this case, we're probably going to be discussing some of the themes we're going to be seeing heading into the beginning of the year. Let's not forget we've got earnings season right around the corner, so this will be a very important one to really get the ball rolling. And as we usually do, I'm going to start this thing off with Chart Trader. You know him as Chart Trader. I know him as Brett Manning. Brett, how are you this morning?
I'm
This
doing
afternoon,
pretty
I
good.
guess.
Yeah, I'm doing pretty good. How you doing?
I'm
Doing
doing
a
all
little
right.
better here, Brett, with that move in the NQs lower.
Yeah, finally, man. What a fight. Good
Yeah, for
gravy.
sure. And actually, Brett, I was going to bring that up first thing. Over the course of 2022, you were, for the most part, fairly bearish on the market. And as you jumped into a trade today, obviously it was short the mini NASDAQ futures. Is that an indication of your overall bias, or was this purely a neutral setup?
Well, yes. I mean, I've been writing for the last few days that I'm looking for an opportunity to short the NQs. I wanted to. So the pattern, if you look at the daily chart, I consider it like a failing triple bottom. Some people would call it a bearish head and shoulders, but we needed this squeeze first, the one that we saw starting Friday and then early in the day yesterday, to really clear things out and set up that pattern, so that when you come back down, you get anywhere near that 10,750 level or so in the NQs. You really are basically trying to form a quadruple bottom, which if you look, over the last few months, it works out that way. And I mean, I was going to say this later, but I'll say it now. I've been doing this a long time. There's no such thing as a quadruple bottom. It's just one of those things. So when I see a triple bottom, it just immediately becomes a setup for me to short any next bounce, especially at a lower high. So right now we're in the part of the pattern where, you know, if we never move back down to that 10,800 area, this whole idea never really comes together.
Hmm.
But this is critical. We really need to eat that tail that we put in yesterday for the bullish thesis on this market. To me, like, this is a very critical time, and it makes sense that this would be a critical time because we are, just ahead of Q4 earnings season. If we see the mega cap sell off on earnings, this is going to be the Nasdaq making new lows for the bear market.
All right. So I guess as far as your overall theme, I know short term you were looking for a bearish play. You got it. It's moving in your favor so far. So far so good on that one. But the overall grand scheme, where you at?
Well, I mean, I always got to take my first piece, but then at this point, I'm really going to give it some room to run, and we'll just see. I mean, if we close down in that, you know, below the low that we put in earlier today, below the overnight low, then yeah, then this is that swing that I'm looking for, that breakdown over the next week or two.
Okay. So that's basically where your head is at and the way you're most likely going to be playing it as the course of the next month or so?
E- Basically, yeah. So I mean, well, let's back up. So first of all, um, obviously a lot is going to depend on Thursday's CPI number, and the estimates right now are really pretty remarkably rosy when you consider what we've been through over the last year. I think consensus is around flat month over month. That'd take the year over year down to about 6.6%. And that basically confirms that sort of hopeful trajectory that we've seen to kind of put together over the last few months. But it also means that there's plenty of room for a negative surprise. Given that we're getting this consensus estimates now that really are, like, dramatically lower. Goldman Sachs note came out, like, really saying, this, if we get what we're looking for here, if you look at it in terms of a going forward annualized number, it's a really sharp slowdown in inflation. And if you remember, so if we rewind back a year ago from right now, we had one of these meetings, and my bear thesis was on full display, and it was really that equities have been living for like a decade or more on the Fed put and the S&P dividend yield put. Right? Anytime stocks sold off when you go before the pandemic, going back to basically the financial crisis. You know, anytime you see some weakening, the Fed makes its dovish bias clear, fixed income money races across the gap, takes advantage of the dividend yields, moving above treasury rates. And that was just the formula for how the market functioned during that period. Then the idea of transitory died a little over a year ago, and the bottom fell out because that was gone. Interest rates are going higher, dividend yield is never going to get above that, and the Fed is on the other side of it. And that's what this bear market is all about, right? So from that perspective, the real full green light bull catalyst would be regaining that sense that you've got those puts back. Rates come down that much. The Fed is ready to ease, and it's going to be a while before that story is something the market's going to be able to discount. So you're fighting against that the whole way, right? And as far as cycle indicators, employment is a lagging indicator. We just saw ISM miss, wholesale sales miss big. Um, wage growth is tapering fast. So there's plenty to hang your hat on to suggest that things are slowing down. And ultimately the driver for that slowdown is what the Fed is trying to cut off, and that's end demand. So you've got this other problem here, which I don't think a lot of people are focused on. I think Mike Wilson of Morgan Stanley came out with a piece basically highlighting this same argument. But if you think about, there's upstream and downstream inflation. And there's a good chance that the first step of slowing inflation could actually surprise people in terms of what it amounts to, because what it's going to amount to is really big time margin compression. So you've got the end demand slowing down. That's basically equals the inability to pass on higher input costs suddenly, and so you get the input costs down by the demand tapering, back upstream. So you downstream pressure drops the inflation, then everybody's caught in the middle trying to make that work, and that puts pressure on the upstream pricing. So the first step in that process, it's like a traffic jam. The first step in that process is probably going to be a lot of drop in profitability for a lot of people.
Hmm.
So that's actually a bear thesis if that's how it works, because you got to see, which side is going to be stickier. Is end demand going to be stickier, or is cost push, from China, Ukraine, labor shortage? My guess is it's the China, Ukraine labor shortage side of that is going to be stickier, and we're going to have to force that down by a lack of demand back up the stream. So that's the first step, is going to be margin compression. And the other thing we have to look forward to this year, and I know that Gavin and Carmine just talked a lot about this, is just basically complete dysfunction in Congress. What you saw in the House Speaker voting process, that's not the important part. The important part is that's a template for every major vote that's going to come now. That exact display is is going to be the exact display we see for setting a budget, for raising the debt ceiling, for aid to Ukraine, for any of those battles. It's the exact same thing that we just saw, and we're just going to keep seeing that. And I don't know if they're going to be able to do anything. And that's not a non-story this year. And where the problem comes in with all of this, so there's reasons to be bearish, but where the problem comes in really, and I think the only problem is sentiment data. I mean, people are still just loaded up on puts. The AAII is festering in that sort of bearish area, and that just makes all these setups so difficult, because anytime you're jumping in short, you're putting yourself in a position to be shaken out hard with something that
Mhm.
just comes out of nowhere, rips your face off. And that's just, I mean, that's it's nerve wracking to be to be looking for something that's on the same side as so many people are already positioned. So that's one of the reasons why I was looking for that squeeze shakeout. The other is just to kind of set up that pattern. And I feel like we've done that. It's just managing, trying to get that exposure in place. I'm not married to this view. It's possible that we could see things shift toward the kind of soft landing direction in a way that really allows people to kind of shift that positioning back the other direction. The opportunity is certainly there, because the positioning is awful in this market. It's already in a situation where if reality really plays along, and you kind of get whatever amounts to a sort of Goldilocks version of a resolution from this point forward, people are not remotely positioned for that. So that's a big vulnerability. And it's one reason why I wouldn't bet the farm on just saying this bear market has to continue. I don't need a stop. Let's just put everything on. Let's mortgage the dog and get short. Um, and because there's certainly the positioning situation is a big risk to that kind of approach.
For sure, and that's why you guys do your sentiment and flow show every month or
Right.
so, or every couple weeks. So yeah, it is a tricky situation, especially when you're looking at positioning and trying to size up the positions and whatnot. So now, one of the things you mentioned, Brett, I'm going to invite maybe Gavin into the conversation. Um, one of the things you mentioned was the potential for margin compression. Now, I'm curious, Gavin, maybe would we see some signs of that during this earnings season? Will some of the companies be talking about that, or is that something that we might see later on in the year?
Oh, that's going to be the top topic for the next month and a half or so as we get all these earnings coming out. Brett hit the nail on the head. I was taking a look at the Mike Wilson note where they went into depth on the situation, and Brett's exactly right in pointing out where you have the prices and end demand generally run in front of the input costs. So that is obviously where you get that margin compression. And where you kind of watching that play out is people trying to put some sort of valuation number on the S&P. I think that's why, when you're kind of looking at the current forward PE, I think it stands at around 230 for the S&P 500 for for this year coming up. But the average trough, according to Goldman, for a recession in earnings is about 13%. Um, right now, consensus views, I don't know if it's come in from this, Craig might have a better idea, but was standing at about 4% as of just the prior month. We've certainly seen some downward revisions coming coming around that, so that should start reining in. But when you're kind of looking at where do we stand in the markets on a valuation standpoint, and certainly we've seen a lot of people talking about that. It's not like it's been the last 3 years where long duration assets were able to run and they'd be trading at 40 times price to sales, or some absurd amount on the earnings front, and people wouldn't care. That's no longer the case. So valuation is arguably the biggest component in the markets. People will certainly look at the Fed, and we continue to see like these Fed tape bombs getting thrown out there. But for the most part, I think people are pretty comfortable with the fact that the Fed's getting closer to the level that they need to get to. And therefore, you only see some of the peripheral trading going on around, say, like a Bostic comment. I think yesterday's fade was a perfect example of that. But really the bigger underlining trend for the markets is that margin compression, how it's going to impact earnings per share, and where that stands on a valuation standpoint for the markets. And that's why we really haven't been able to find any buyers above the 4,000 level, because when you start getting up to that area, you're talking about a forward PE that we're trading at about 18 to 19 times. And that's with question marks around the validity of the denominator in that equation too. So that's why people have just been unwilling to buy up at that area. So I think I saw something in that Wilson note where the mention of margins or operational efficiency was like an all-time high last earnings season. So companies are definitely focusing on that. And what you're going to see a lot of this earnings season is winners and losers based around who's managing that margin compression the best. And that's going to be a real differentiator. It's going to make for some choppy markets, and it's really going to make for a stock picking environment, in my opinion. So yeah, I think Brett hits the nail right on the head with highlighting that margin compression is the biggest story over the next 6 weeks.
All right, Gavin. One of the things that you like to do, we talked about this in our pre-market chit chat, but there were some things that you saw in the Jeffries report that you think will be relevant, particularly for some of the names like Goldman Sachs. And I couldn't remember exactly what it was, but you did highlight something that I think we need to be on the lookout for. So if you could just rehash what you saw from the Jeffries report as a little preview for the bank earnings that we're going to see later this week.
Yeah, I mean, Jeffries kind of encapsulates what we're seeing out there with their profit fell 52% year over year because their investment banking fees, which is a high profit, high margin business for them, um, uh, is under intense pressure. You know, nobody did an IPO last year. M&A has definitely been at a standstill as people try to reassess the cost of money. So you saw that performance pretty weak, and that's going to be extrapolated on the rest of the investment banks, the Goldman Sachs and Morgan Stanleys. When you're looking at the trading revenue was under a little bit of pressure. They did do very well on their fixed income, which is interesting to see. I'd like to see a little bit more of a deeper detail if they were just winning a lot of market share because maybe other companies couldn't get underwriting at some of the other investment banks. Perhaps that's something that we'll see play out, but that's going to be a theme that we're watching during the bank's earnings season. But expectations are low for this group. Everybody knows it's a difficult environment for them. I did think Jeffries kind of had that little better than feared, which I know a lot of people hate to hear. But when we're trying to figure out what that EPS baseline is going to be, this all gets factored in. So when we get the bulk of the bank earnings, they're obviously a great read on financial conditions and overall economic growth. So, we're going to be watching a lot of the loan growth, which we didn't get that information from Jeffries because they're unwinding their merchant bank. Um, we'll be watching the margins, net interest margin, net interest income, to make sure that they're expanding for the banks as that they're supposed to be. But again, the loan growth is going to be watched. Mortgages, auto loans, that's all going to come under pressure. And then, of course, there's the credit card, where the consumer spend is a key driver of inflation. Powell's laid out wages and spend in the travel and entertainment area are key drivers of that inflationary aspect. So, what kind of loan demand did we see from consumers specifically on credit cards? What kind of delinquencies did we see just for financial conditions? So, they're going to be the things that we're watching pretty closely when all those banks come out, and it's going to just kind of set the pace for the rest of the earnings reports to come. But people are going to be watching those margins real close, and you'll get a little bit of a sense of that from the banks. But overall, the banks, outside of a read on the financial conditions, aren't going to give us a ton of insight into how an industrial or some of the cyclicals are doing on that front.
All right. So outside of that one, what do you think the most important sectors as far as earnings go are this particular round of earnings? It's the Q4 earnings season.
Well, tech and the reaction to tech will certainly be of interest. I mean, we've talked a lot about over the last few weeks. The breadth of the market's actually decent when you're looking at stocks trading above their 20, 50, and 100-day moving averages. They've all been moving higher over the last few weeks. But where you get the big drag is from those mega cap growth names. So, Brett had mentioned them before. How do we see a big leg down in Amazon in reaction to a poor earnings report because of margins there? Does Apple roll over in all those, iPhone City fights that we're seeing hurting supply and production? Does that start kind of coming into play here? And these names are still big weightings on the overall indices. So in the Nasdaq, Microsoft's still 12% of the weighting, and Apple's still 11%. So that's nearly a quarter of the Nasdaq from those two names. Microsoft's valuation is one that's up for plenty of debate, trading at about 23 times forward PE. So those reports and the reaction to them are certainly going to be key for the overall broader market. But I guess the other thing that I would mention is, don't lose the forest through the trees there, where you could be seeing some bubbling up of some of these better leveraged names and these other names with better margins operating well under the radar. And people are just kind of throwing things out because they see the broader market indices dropping because Apple had a poor quarter. So that's one of the dynamics that I'd be looking for. But certainly those big tech names are once again going to be a big importance to the broader market.
All right, let's take the opportunity to bring in Craig, Trend Tracker. Craig, how you been?
Good, Jim. How are you?
I'm doing well. Hey, your mic sounds good.
Yeah, we got a new one.
That's
Got a new
good.
headset, so
Good. All right. Well, that's good.
ready to rock.
All right. Well, let's rock. What are the names or sectors that you're going to be looking forward to as far as the earnings season that's coming up? Some of your names.
Well, obviously, mega cap tech has been a drag, and so those are going to remain in focus. Um, you know, Coming back to the broader market just a little bit. As Gavin mentioned, markets at about 17 times, and earnings are expected to go about 4% in 2023. I see Capital IQ, S&P IQ at like 226.50 ish for 2023. It was looking for 10% growth probably 4 6 months ago. So that's come down. And Q4 earnings, which we're going to hear now in these coming weeks, are expected to actually fall 4%. And entering October, we're expected to grow 3.5%. So down quite a bit, 6.5% over the last 3.5 months. So the 20-year average is just under a 4% decline. So, estimates have come down a decent amount, obviously, as the economy continues to slow, bearish sentiment has continued to increase. So, there is kind of a bar, but, is that enough to create a bullish setup here? Is anybody's guess. We're seeing leadership in global, the component, industrials, staples, utilities, healthcare, more defensive sectors, but also sectors that are benefiting from the pullback in the dollar and perhaps the China reopening. But yeah, mega cap tech remains the laggard, and on a case by case basis, it's hard to put a stake in the ground one way or the other. Amazon and Microsoft are likely to report slowing growth at cloud computing businesses, which are big cash cows. It's going to make sentiment in the software space probably it will probably remain negative. But as estimates have come down and these stocks have come down, the valuations are now quite reasonable across the board. So it's reasonable to make the case that AWS or Azure could miss, but maybe they're priced in and we could rally on these prints. But so I really don't have a lot of conviction either way. So if looking at advertising, it's likely to be soft. But again, for Google and Meta, estimates are quite reasonable and pretty low. So maybe they can finally deliver to the upside. Problem with both Google and Meta is, a bloated cost structure. Facebook announced some layoffs recently. I think there's an expectation that Google will this year as well. Going back to what Brett and Gil were talking about last year, basically was just a lot of companies, a lot of sectors were over earning, and the retail sector was maybe the most obvious example of that. As inflation picked up, margins are coming down, and now this year margins are probably going to take it on the chin. So there's just a ton of cross currents. And with historically average valuations and the Fed still working against us, it's hard to be really bullish. But if we get a cooler number on third earning with the CPI, we do feel kind of primed perhaps for a bounce. As Gav noted, the growth has been improving outside of maybe the mega cap tech and profitable tech companies. So yeah, I mean, I like Meta because it's so cheap, and sentiment against TikTok continues to grow. So, I think Meta still is well positioned for the long term, even though I really don't, no one really likes the massive amount of money they're putting into the metaverse. But, the company's still really positioned over the long term. Whether or not they will beat or miss in the Q4 print, I don't have I don't have a ton of conviction either way, but at least Meta is certainly a value in tech or media space. One that I have been long and I continue to like, and exiting this cycle whenever it does bottom, is ZipRecruiter. I know it's an employment platform. So the Fed is actively trying to work against them, but this is again a value stock, low teens PE. Perhaps estimates for next year need to come down, but this is a cheap and really well run, executing really well business. So I think we got 14 times earnings right now, about 11 times EBITDA. They're growing. It's a small cap profit business that once we kind of do get past this cycle, whether it be this year, later this year, or even into next year, it's a stock that can work really well.
What's the ticker on that one?
ZIP.
ZIP.
So it is an IPO. Unlike a lot of recent tech IPOs, profitable business. Valuation is attractive. Again, the cycle is working against it here. I mean, the Fed is actively trying to, take down the jobs market. So I don't think sentiment will necessarily improve anytime soon, but I think they did just re-up their buyback, indicating they're going to have another solid quarter. The more assets come down in the next few months, and the more weakness we see in the stock, I think it is going to create a longer term great buying opportunity. Strike is another one, CWD down here under 100. That the stock's trading at 20 times sales for a long time, producing cash flow. I think the free cash flow multiple on this stock is, I think, down to like 26, 27 times. So you can't, 27 times cash flow isn't necessarily a steal. And I think security has been kind of a favor here because there's concerns of competition. It is a competitive field, and CrowdStrike did kind of tell us that the next couple quarters aren't going to be, they've just been beating and raising ever since the IPO a few years ago, and that story kind of ended last quarter, which is why we saw the stock get crushed. So, I'm not necessarily expecting return to beat and raise, but the valuation is now very reasonable, and they're doing really well, but the infinite growth trajectory that they were on is now kind of reality. So I think 100 it's worth accumulating. I'm also long Google because there's value there. Couple growth stocks that I'm not in, but I'm intrigued with are GitLab, GTLB, and HashiCorp. In a note of GitLab on the long side, and I do like it at this level. I think it's trading at just right around 10 times sales. So, that used to be, if you take away the last 5 years, 10 times sales was like a reasonable ceiling for a company like this. But yeah, this is, so I over the last 6 months or so, I've been just trying to be more tactical and focus on shorter time frame. So, I've had a couple good entries and exits in GitLab, and I expect to have more in the future. And yeah, there's also a lot of short potential short opportunities here if we do continue to bounce. I think stocks like Coinbase, which I'm still short, maybe Beyond Meat or Rumble is a SPAC. All stocks that still still have tough valuation headwinds, in my view.
All right. And I believe, Brett, you might have had a question about Google, and I think a good person to answer that one might be Craig.
Yeah, so let me preface this by saying, so I used to live out in Palo Alto, and my wife is super connected in the VC community, and so I get kind of like a filtered version of a lot of what's going on. And something I started to hear over a year ago was a lot of money starting to gun for completely disrupting Google into oblivion. And the real emphasis there is that like search is just there's a paradigm shift that's going to happen, because a lot of what you do when you try to use just like Google search to find something, what you get back is a raw interpretation of the internet, and now we have got artificial intelligence and you can get a filtered interpretation of the internet.
Mhm.
And Google already has so much invested in that raw interpretation because of how it places ads, and that's its revenue model. And there's starting to be some movement on this that's developing in a really profound way right now. I don't know if any of you have ever heard of or used Chat GPT.
Yeah.
And the whole chatbot kind of thing starting up, and this open AI thing is going to be like the most valuable startup on the planet after their first round. They're going to be worth like $30 billion, because of the amount of interest in what looks to be like a paradigm shift that Google's not going to be able to participate in, even though they're the leaders in the space, and everybody who's doing this is a former Google employee. So like they just left and went and did this because it was clear to them that this was going to be the next horizon, and Google's kind of stuck in a particular model. And they can't really take the type of risk you take as a startup and just break things and go crazy. Um, so like this is now going live, like Chat GPT is something you can use now. It needs to be refined. There's other chatbots, but they're super sophisticated AI, and instead of searching the internet, you just kind of have a conversation with an AI that answers all your questions, and in a way that delivers it in a much more refined manner than you get in a Google search. And I know that Google recently, there was some leak or something that says that they've placed this as like I don't know, a super red flag situation, and they're pouring money into trying to figure out what to do. But does that figure, like, how do you guys look at a situation like that? Because this can happen. This is still a Silicon Valley tech company, and these things can get completely upended by the next revolution. So how do you analyze that from I mean, the way that you approach things? Like, how do you take that into account?
Well, I mean, that's what's tough about technology investing, right? That these are advancing so quickly, and so there is a lot of competitive risks that can come out of nowhere. I have used Chat GPT a decent amount. It's fascinating, cool. And I encourage anybody who hasn't tried it to go on, and you can just create an account and use it for free. But so well, there is some sort of existential risk to that cash cow. I think it's worth pushing back a little bit. I think Sundar Pichai has said publicly recently that they have an even better product than Chat GPT, but they just haven't released it. And it comes down to the strategy of not wanting to their own cow, right? But they did acquire a company called DeepMind in 2014. Apparently, they could um, release a product that's similar that would have that's even better. Hearsay, I guess, but worth mentioning. But
Do you
um,
think they would ever just consider waiting for these things to refine and then buying them?
well, so Chat GPT, apparently Microsoft is going to be taking over
Oh,
effective
okay.
ownership of this thing. So yeah, they're
They
in
just
talks
put
to
10
raise
billion
like
in it, right, Craig? I know they invested $1 billion in 2019. Microsoft
right,
did.
and now they're in talks. I think it's close to closing soon. There's been reports over the last few days. They're gonna be taking like a very unique structure where they're gonna be um, basically taking they're going to invest 10 billion and they're going to get the majority of any profits until that's recouped, and then they're only going to get half of the profits. But effectively they're the ones who allowed this to happen because they've been giving them all this AI takes a lot of compute, and ChatGPT, because Microsoft is an investor, has been using Azure. So Microsoft has been giving them compute credits from Azure, and they're not really even monetizing it yet. So that's why this $30 billion valuation is kind of eye popping. They're not, it's a free product for now. I'm sure they have a lot of enterprise customers and stuff, but
And it was valued at just 10 billion at the beginning of last year too, right, Craig? Something
right.
like that.
And now that this ChatGPT came out, and it's really the talk of the tech world over the last few months. I guess I think it was probably put out in like November, maybe early summer. Yeah, so I mean, Microsoft is basically going to have control of it, and there's word that they're going to try and incorporate that into Bing search. And there's really no reason why Google can't kind of just incorporate that a conversation like different feature into their own search. But again, it's wanting to protect their own cash cow, right? I mean, the applications for for ChatGPT, whether it's in coding or it really is fascinating to use. But Google makes its most money off of searching for travel and insurance and certain things like that. So
Right. Well, let me put it this way though. I think that the revolution is the idea that when you do a Google search for anything, whatever you're doing, there's a secondary step that happens in your brain and in your mouse and in your clicks and in your movement through an information set, analyzing it. The result of that work that you put into it then returns the result you're looking for. So the search doesn't return the result you're looking for. The search gives you a body of information, and then you comb through it and you do a process of analysis, and then you get to the thing you're looking for. And the disruption is simply an AI that can take away that middle intermediate step of work, which is kind of the model for disrupting something like that. Like there is a part that happens aside from the search results that gets you to the effective the result that you're looking for, right? It's not the search result isn't the result you're looking for. The search result plus your intellectual cognitive work and your analysis gets you to the result you're looking for. And so this is just simply disrupting that middle ground with AI.
Yeah, I'd like to add an anecdote. So my son, who's in high school, my younger son, was doing research on a paper a couple of weeks ago, and he was searching something, and he, plugged in the search term. And he's like, "Man, it's like I got to now go through all these search results to figure out, the information I'm looking for, right?" And I'm thinking in the back of my head, I should tell him about Chat GBT, but if I do, he'll quickly see that it'll write his entire paper for
Yeah,
him.
right. I mean, so part of this is also dystopian, right? Like it's yeah, you
yeah.
take away enough of the work of living, and what do you end up with?
And
Well,
I've seen videos just talking about it, how it could, like people are using it to write code, right? Like this disrupt the market for software engineers. I mean, people are saying, "Hey, do this, create this code for my website," and it's just like spitting out the code in 10 seconds.
Yeah, apparently with code, it is very effective and very efficient. But another anecdote, I guess, is that it isn't always. It's basically sourcing this. The Chat GPT is basically just sourcing things off of the internet, and it's not always accurate. I mean, there's been
Right.
dozens and dozens
Which is
of
why it's tough
examples
for
of where it's giving you the wrong answer. But so I actually read an interesting piece about how in the future it basically using AI, you're still going to have to go and verify everything that it spits out. So it's kind of like, younger people, digital natives, have kind of grown up knowing you can't believe everything you read on the internet, where um, you know and it's kind of the same thing where, like, yeah, like, we shouldn't be necessarily being AI tools like this in schools. We need to teach people how to use it, because it is going to eventually take over, right? So it's, taking it and verifying it, and because obviously it could into a lot of issues with plagiarism, and yeah, just have the AI do your homework. But it's going where AI is going to be incorporated in a lot of things. So it's being able to verify instead of just believing everything you see, whether it be on internet or from an AI.
Just one thing that I'd throw in, because I'm sure a lot of people are sitting there wondering, how do I get involved in this? And unfortunately, it hasn't IPO'd yet. But Microsoft has that relationship that Craig was just talking about. And it's really all the big names. Amazon was also a big user of the technology, as is Infosys, INFY. That's the name that might fall under the radar. And then Brett, I know Google's got a rival for this, right? Craig, isn't it DeepMind or something? Isn't that their version of this?
Yes, and they paid like almost $1 billion for it back in 2014. So again, there's people saying, "Oh, this is a huge red flag," and Google are panicking. But then there's also people saying, "Well, they have similar, they have a similar, they have similar capabilities. They just haven't necessarily pushed out a free product like that yet." So obviously, the strategy behind how they're going to implement. They're very much focused on AI. I mean, I'm not sure if there's any one company that's been investing in AI more than Google, or obviously Amazon's up there too. Microsoft obviously is not. Yeah, I don't think this OpenAI probably not going to ever IPO, because it seems like Microsoft is gonna be Microsoft's for the most part. It was actually started as a nonprofit, and
Yeah, by
blah
Elon
blah
Musk,
blah.
right?
Yeah, he was one of the early investors. Yeah.
I just saw he lost a record for any one person in a year, but maybe this will help him make that up a little bit, right? But yeah, no, I saw Elon Musk started with what, a billion in funding back in 2016 or so. So you should. You wonder, given the impact that Twitter had on Tesla, does this provide a boost to Tesla shares, right? Do you think that plays in at all, Craig?
I don't think I see a real impact on Tesla, but
Okay.
but coming back
Well,
to
because I mean, but you could make the same argument that Tesla was losing money because of Twitter, right? Where Musk was forced to
sure.
sell shares in Tesla to pay for the Twitter acquisition. Can that flip for
I,
Tesla with this open AI?
no, because again, like, Microsoft is taking it over. So he's never gonna, like, necessarily see any from it, other than, yeah, his equity is going to be worth a little bit more, but it's not like he's going to be raking any profits from OpenAI, I
Okay.
don't think. Um, and coming back to what Brett was saying, Alphabet will eventually have some sort of answer, whether it be their own version of chat GPT, or whatever. And so, yes, I mean, there is risk that their search cash cow will eventually under pressure, but at mid to high teens EPS, what is it, 10, 11 times EBITDA. I mean, you can make the case that, I mean, I'm not saying this Google can't keep coming down. We can't see more multiple compression, but it's not like this is like super expensive stock anymore.
What
So
one last question I would have is, I mean, I feel like there's a, if you're a startup that's just getting going, you can take more brand risk. If you're an established company that's been around, where your brand is worth everything, you can take less brand risk. And there seems to be something and I read an article that kind of made this argument, but with these things, you're getting an authoritative voice that's describing to you aspects of reality, and if Google's brand is behind that, like you said, there's this big problem of, it may be telling you something that's not true, but it's doing it in a conversational, authoritative voice. Here are the facts of this situation. Bang, bang, bang. And it seems like there's more brand risk for Google to put something like that out until it's extremely
Exactly.
extremely well, curbed and guided and bound, to be really really, a low probability of mishitting on something important. So that
Exactly.
puts them at a competitive disadvantage, I would think.
For sure. Sure. And it also, and again, it's yeah, brand. They don't want to taint the Google brand. I mean, search is obviously their cash cow and what everyone is going to custom use it. So they're not going to push out a product that isn't 100% ready, which again is the advantage to the startup, who really has a lot to lose.
So I guess the model then is to wait until OpenAI gets it right and then buy them, or buy somebody else who's done, because there's competing models. ChatGPT is the first mover that's notable, that's popped above the surface that everybody sees. But you may hear about something tomorrow that's in beta testing that blows it out of the water.
Sure, sure. And again, Microsoft pretty much has taken this one out already, and there are reports that they want to incorporate it into the ring search. So maybe that's the catalyst. Google the answer with their own competitive product, because now all the Microsoft is getting from it.
And I guess I brought it up because I think this is a huge factor when you're looking at like the next 10 years in the tech sector.
For sure.
And one other way to invest in that too for people out there, NVIDIA, they do the GPU chips for a lot of the OpenAI functionality. So
Right, and that's still the best way, because anything to AI needs those NVIDIA's GPUs. So the gaming cycle continues to present some risk near term to NVIDIA, but the demand for their GPUs and machine learning applications, AI, is still
10-year run rate, right, Craig? I mean,
I mean,
long demand.
Whether it be the hyperscalers like Google or Microsoft, or different industries. The AI trend obviously is only going to get bigger and bigger. And unlike Metaverse, which was kind of like 2-month hype trends that like the top a year ago. Yes, the Metaverse is going to be a thing eventually, but AI is probably the strongest trend in tech going forward and longer term, which is why NVIDIA is NVIDIA's been the best way to play it, and I'm not sure if that changes anytime soon.
All right. Well, thank you very much.
Thank you.
All right. Well, that was a deep dive discussion that I didn't have on the agenda. But one thing I do have on the agenda is bringing in Damon, aka Scalp Trader. Damon, how you been?
Hey, pretty well, pretty good. How about you guys?
I'm doing well. I can't speak for everyone, but hanging in there.
Doing good here.
All right, good.
Just wanted to get an update on what you've been doing lately, as far as the trading vehicles that you've been pursuing. You've been kind of back at it in the, I would say, the old school day trader style. So, what type of things are you taking a look at, and where are you leaning towards?
Well, on a short-term kind of intraday basis, you're seeing a lot of the distress stuff come back around. Earlier today I highlighted Beyond. What was it? Bath and Beyond, BBBY. Saw a little pop there. Mentioned that Party City might see a little squeeze action by momentum players. See, that's making fresh highs now at 52%. I like to play in this space, and I think you're going to see a lot more bankruptcies. Obviously, in 2023, credit markets are tight. People are sitting on cash. Lenders are sitting on cash. Interest rates are sky high. Really, like companies that probably are not in that much trouble, that probably have enough cash to last another 2 years, but maybe want to refinance some debt or just get a little more liquidity. I mean, they're having to borrow at a double-digit rate, and a lot of times also throw in warrants. So it's not, a year and a half ago where some of these speculative technology companies were able to issue convertibles at a 0.5% coupon or 1% coupon. The world has definitely changed a great deal over the past year. So in terms of, I guess one of the things I wanted to talk about is, and I wanted to bring this question back around to the rest of the team, is, I'm thinking about, my portfolio. Last year, I was almost entirely cash for, almost the entire year, and traded around that. But just looking at valuations, just thought they were absolutely terrible, and was willing to participate in some speculative things just for the price volatility. I've reduced my cash holdings significantly and kind of set up my portfolio almost as like a private credit fund. So I've been adding a lot of preferreds, a lot of BDCs, a lot of mortgage REITs, commercial REITs, because I think this is going to be a really, really compelling lending environment. Interest rates are super high. Liquidity is not strong out there. So the terms and conditions that lenders will be able to achieve in terms of lending out money are going to be really compelling. So, for example, if there was
compelling for the borrower or lender, Damon,
for the lender, for definitely not for the borrower.
Yeah, that's how I figured.
Yeah. So like borrowers in the office space, right? Like they can't refinance their loans. Really at all right now. And you're going to continue to see that in other parts of the market. And so, say for a commercial lender, or we'll say, commercial mortgage REIT, for example, if last year they were lending at, 70% loan to value, this year it might be 50%. And that's after they've repriced the property to account for, some decline in the value of the property, right? So, and, more restrictive terms. So for the companies that the private lenders that make it through the other side, so the ones that don't have a ton of office exposure, right? Office is absolutely terrible. Like if you own something that has more than 25, 30% office exposure, yeah, I'd really have to question whether you want to stick around that, because office is in really bad shape. You have sponsors, major private equity funds that have tens of millions of dollars or more already in a deal, simply walking away from these deals because the values are falling so dramatically. They just think it's not worth putting any more money into them. So it's a really interesting time. So I think that portfolio that of yielding, higher yielding instruments of 9, 10, 11, 12, 13%, which we've been buying over the past several months. I think that's a very strong core portfolio, and then to trade volatility around that, right? So if I can pick up, say, 10% and then also get capital appreciation of 15 to 20%, and then just kind of trade volatility with a portion of the portfolio, I'm okay with that. I don't need that much actual cash to trade the volatility opportunities. So I think it's important to think about kind of that core portfolio piece, right? Like you don't want to be sitting. Well, I was going to say you don't want to be sitting in cash, but I guess the reality is that sitting in cash, having a piece of your portfolio in cash, isn't necessarily that bad any longer. But it's important to think about where your cash is, right? Because there are some brokers that are still paying basically 0% on their sweep accounts, where there are other brokers paying 4%, right? So if you have cash that you have on the sideline that you're waiting to put to work, or you're recycling it through trades, that's just easy, right? Like that's just easy. You got to make sure you're taking advantage of that situation. You don't have your cash just sitting around not collecting anything, right? So definitely, I mentioned that in a comment a couple months ago, and did a whole series on cash is no longer trash. I think at that point, I think the best sweep accounts I was seeing were probably around 2.7%. I mean, we're at close to 4% now. So even more kind of, motivation to look at what you're getting at your current broker and think about whether it makes sense to make a move there. So I guess one of the things that I wanted to talk about is, just with from the team, just overall kind of portfolio positioning. What are you guys thinking in terms of, obviously, we're trading, we're active, we're speculating on a variety of things, but how are you guys looking for, for that individual who is, who has an actual portfolio and they're thinking about, hey, what do I do with that, right? Like, I don't want to just sit in cash. Like, how are you guys positioning?
So I can go first real quick, but so I've been since 2016. I started to do a more active job of separating my trading capital out and having a kind of longer term book. And actually, I put it with I took half of my capital and I put it with somebody else because I was sure the market was going to go up. And I felt like it was going to go up in a way that I was going to have a difficult time managing. And just I actually put half my money with someone else that I knew was going to be extremely low turnover, extremely long only, and extremely diversified globally and across different asset classes, but mostly with favoritism toward on the fixed income side it was junk bonds and lower quality, and then it was equities, and it was mid caps, small caps, and global, and just low turnover, and just let that happen. And last year, I took most of that back, and I posted at the time. So I was just starting to get a little bit worried about the situation, and for me, it's been transitioning back to trading more, having more of an emphasis when volatility is higher. Just more of my financial situation comes down to trading decisions. And I felt like in 2016 and heading into 2017, um, because of where we'd gotten to in terms of long-term sentiment indicators, I just really felt like it was going to be tougher for me to accomplish as much just with my trading. And the first half of 2022 was one of my best periods that I've ever had, because I was bearish and I was right, and I had several 1,000 point trades in different futures contracts, and that was the big payoff. And you know, then we got to the dollar turn, and I put some money in emerging markets, and I talked a bit about that, and I put some money in precious metals with silver, but I haven't yet gotten back to the strategy of saying here's refilling the kind of long-term out of my hands account and sitting on my hands. So it's really still to me about a couple of different macro themes, but otherwise saying, I'm gonna trust my ability to figure out shorter term setups in a volatile market when setups are ripe.
All
All
right.
right. Anybody else want to pitch in? Go ahead, Gab.
Yeah, I could go next. I completely agree with you, Damon. I mean, that's generally how I run my portfolio, where I've got I basically have it broken down into three different areas. One is more of a macro, where it'll really be just kind of trying to time indices, be it the SPY or the Qs, or perhaps a macro ETF that I like. Then the other group that I have in my portfolio is more of a stock picking portfolio, where I'll be looking for names, and I'll get into the types of names that I'm looking at. And then, of course, there's the trading portfolio, where I'm doing more of my shorter term swings and a lot of my futures trading, which is the one that I discuss a lot on the site, of course, for Briefing Trader. But I mean, names that I'm kind of looking at. Well, first, themes that I'm definitely looking at is one, looking for stocks with leverage to a decelerating inflation environment. That's certainly something that is appealing. We talked a lot about the margins earlier, looking for companies with resilient margins. And one of the key things too is I'm looking for companies with margins that didn't get a margin improvement last year simply on an SG&A basis, so that they're able to not just cut the fat and all of a sudden be at one level, because if you're going to see a prices decline, that's going to be an issue down the road here. So trying to thin out the names that have good margins but aren't going to get caught up in that. And then, I'm definitely avoiding some of the more long duration equities. There's names such as a Nvidia or something along, or Amazon, that I just think are strong names that I'm not trying to guess tops or bottoms that I'll be okay owning, but certainly not looking for anything that's a big long-term hold in that. Now, there would be a name like maybe a Charge Point where I've got a thematic 10-year investment horizon on that I could include in there, but that's going to only be a small portion of the portfolio at this point. Certainly defensive names are sticking out a lot more for owning in this type of in this type of an environment. Now, stocks that are leveraged to decelerating inflation, I'm just going to go through by kind of sectors. You got medical equipment fits this rate, semiconductors, consumer services have a high strength in this area, and also looking at, believe it or not, some software names too. That as you know, most of these software names have those high margins, but you're going to have to be um, pretty careful with some of the declines that you're seeing on sales and on growth. But a few names that kind of fall in for stocks leveraged to decelerating inflation that I would throw out there for you. Citigroup is a good one. You got the telecom service providers, AT&T and Verizon fall into this realm. Truist Financial, TFC, is a name that pops in here. Lowe's, LOW, is another name that falls in under that category. Applied Materials, AMAT. Don't forget, we're going to have that chip bill that's going to be put into effect this year for the U.S. government subsidizing some of the chip build outs. So an AMAT could perform well in that range. Stocks, some of the stocks with resilient margins that I'm watching. Lamb Weston, which we saw just take off a couple of days ago. That's a good name here. Deckers, DECK, is another name that falls in under that realm. Visa and MasterCard. You're certainly going to want to keep an eye out on credit strength there, but these are some names that will fall in under that realm. Caterpillar, which I already own, that's another name that jumps in here. And then just a few names that I'd throw out that had margin growth, but generally due to lower SG&A that you need to be a little careful of. Netflix, of course, Merck, MRK, which is a name that's fallen on here. Microsoft, which we've talked a lot about that today. And Google also falls in under that parameter. And then just an oil play that I'd be careful of, ConocoPhillips, COP. In general, I like the energy and oil space, and I like them for a portfolio hold in 2023. But that's one name that seemed to get a big boost from its margins because of a reduction in SG&A. So there are a couple of the things and themes that I'm looking at in terms of a longer term portfolio hold. As for trading, that really just comes in on a day by day basis. And I'm always looking for those good multi-week swing trades that tend to work out. So that's kind of how I'm approaching this year.
Okay, good stuff. So I wanted to ask you guys your thoughts on, obviously last year was a fantastic year for shorting. And, as we approach the end of the year and as we move into 2023, it seems like the crowd is leaning short. Institutions, individuals, everyone wants to short every pop, right? And I don't know, in terms of that positioning, how do you all think that plays out over the course of this year with so many people kind of giving up on the long side and, joining the short hordes?
Well, I mean, I started off by saying that's the big problem with trading right now. This is Brett, chart trader.
Yeah.
I mean, like it's frustrating and difficult when you see the picture going in the direction that people are already positioned for. And you get that, it's in the later stages of bear markets, you still get the move, but you have these terrible shakeouts in between. Like and we've seen a lot of this over the last month. You can see how many times we've seen, or even over the last several months, we see these moments where it's like, oh, the Fed is pivoting. We get like a 5% rally in one day, and then we find our peak and then we roll that whole thing back over. And it's kind of like that's the rhythm, but it makes it so difficult to position yourself to take advantage of what you think eventually is going to happen. And I'm not married to the bearish view, but I see it working out for the first part of this year at this point, just based on patterns, just based on all the points I made at the beginning. But yeah, it's really, really difficult when everybody already owns all, just crazy amounts of puts, and thinks the market's going to be down a year from now. And I mean, it becomes more of a friction in the trading process than anything. It doesn't mean the market has to rally, but as I always say, when you have that kind of situation, if you get a material change in the world that's real, nobody's positioned for it. That's when you get the big, big move. And this market is definitely vulnerable. If we see a resolution to some of the biggest issues that we have, that's materially and substantively better than people are positioned for and better than people are expecting, yes, you're right. We're positioned for a big response to that. But you have to see that. You have to see that things evolve because there's real problematic issues.
Yeah,
Anyone else want to chime in? Go ahead.
yeah. So for me, as we talk a lot about, it's always tough to short when everybody's looking at it, right? Just because the very nature of the operations for trying to short means you got to have people just willing to sell out, and we really haven't gotten a lot of that. Certainly, we had a nice washout from the highs of last year all the way through, but we've kind of hit that lull where Brett's talking about, where you need that next catalyst to go down, and we simply haven't really seen that. I think the most likely scenario again is going to come in some really poor earnings, maybe some bankruptcies, that the stress space starts picking up a little bit, but until we see that, there's always feels like there's that benefit of the doubt that the market's willing to give, because recessions are so rare that it's not setting in. So, we might need to have something happen like a reload where all of a sudden we get decent earnings and people start piling in, and maybe Powell messes up and says that the Fed's not going to raise any more or something, and that gives in that little additional juice where it lifts the market up high enough that you could see that reversal and that drop down and break through some key support levels, and people start throwing in the towels on that, some weaker econ data and things along those lines. But it's just been very difficult to short because, as we've been saying, everybody's kind of looking for that same outcome. Everybody thinks we're going to go down early in the year and then have a great second half of the year. And when everybody's looking at the same thing, I don't want to say that it rarely happens at all, because that's not the case, but it does make it a little bit more difficult. So you kind of looking for some of those pins to drop that would have people willing to sell, and we simply haven't gotten that because everybody's kind of on the mindset, yeah, but the second half of the year is going to be really good, so I'm just going to hold on and wait this thing out. So we need that to break in order for us to really get down lower. And I think for that to happen, you're going to need some really poor earnings reports and some poor guidance numbers and things along those lines. And that might not happen in the Q4 sector. It might be a Q1, Q2 phenomenon, but that's again what we're going to be watching this earnings season.
Yeah, sounds good. Well, one of the things that I'm paying close attention to in tech, and in terms of for getting back in, is obviously the compensation levels for tech were pretty. I mean, I don't want to use the word obscene. Like, happy to see people make money, but when you're offering kids right out of college with a CS degree $250,000 packages. That's unusual, right? You wonder how long that can last, and you're starting to see a lot of trimming of headcount. So I think there could be an opportunity in tech as you continue to see these layoffs and the expense structure, be shifted to a lower base and maybe less stock dilution. You might be able to get a bid in tech a stronger bid in tech later this year. I'm not sure how far into this year, but you're really starting to see an acceleration of these job cuts at tech companies.
You know it is when they create there's a website, layoffs.fyi, that tracks all the tech company layoffs right now. So you know it's in vogue when you got websites tracking this.
Yeah, definitely.
But again, that's to the point that I was making earlier with being careful of grabbing companies that's seen margin dilution, or that's seen margin improvement purely on the basis of cutting the fat. You want to see it on an operational side and a price demand side too.
It makes sense.
All right, fellas, are there any other themes that we need to touch upon before we wrap things up on this?
I'm good.
I'm good.
All right. Well, there's a lot of meat on the bone of this one. So I strongly encourage everyone to check this one out again. Deep dive discussions galore for our team today, and a lot of good ideas. Took down a lot of notes. I'm gonna have to go back and do it all over again and listen to some more just so I get some clarity on all this good stuff. Anyway, gentlemen, thank you guys so much for participating today. We thank everyone for listening in. I'll have this one back up for you, in, I would guess, in the next hour or so. But once again, gentlemen, thanks as always. Have a good one.
You
All
too,
right,
Jim.
everybody have a
Thanks.
good one out there.
Okay, bye.